Hi there, and welcome back to the Metaverse Stock Exchange. It is the first Friday of the month, and that means Jobs Friday. That is the day we get the monthly jobs report. And keep in mind, this is crucial for the Federal Reserve easing its kind of tightening on the economy. So, according to the Fed Chair Jerome Powell, he said that when labor tightens up and wages stop growing higher, that's the last piece of inflation. So, in their mind, they need to see higher unemployment and wages stagnating. And although that's contradictory to what we normally would like to see, which is more jobs, more people employed, more money coming into the pockets of employees for inflation fighting purposes, we need to see higher unemployment, fewer jobs, and then wages stagnating. So, what you're going to see today is the exact opposite. This is pretty much the worst employment report that we could have had, again, from the Fed's point of view. From the economy point of view, and for President Biden, I assume that he's going to come out in the during the day and say that this is just an unbelievably strong economy. So let's see, why is that strong. So first we have average hourly earnings year over year. This is even a good number because it's 4.4%. It's still higher than what the Fed would like it to see, but it is a decline from the 4.8% last month. And this is because as the older months, when we had higher kind of month over month changes, get out of the equation, this number should be coming down. But we were expecting it to go down to 4.3. So even the good numbers are okay, but still worse than what we were expecting. Average hourly earnings month over month. So this is what we need to see, at least 0.1 or 0 or tops 0.2. It came in at its expectations at 0.3, but we did have a revision last month. We had a 0.3, we got it up to 0.4. So even though we're slowing, we're still having a good pace of wage increases. Again, something that the Fed does not want to see. Next one, average weekly hours worked. This is 34.7, again jumping from a 34.4, which is unbelievable because more people are working more hours. And we're hearing all the time that the people are getting laid off, or that there is fewer jobs, or manufacturing is slowing down, or all these sectors slowing down. That is definitely not what we're seeing here. We're seeing that workers are working more hours right now. Okay, so they're working more hours. Let's see if there's more workers working. Government payrolls, 74,000 jobs in government added just in the last month. Next one, manufacturing. We've been hearing all the time how the manufacturing sector is slowing, but as you can see, we got 19,000 more jobs compared to the 6,000 we were expecting, so 3 times more than expectations. I don't see a slowdown there. How about the headline number? This is the number that you're going to be hearing about on pretty much all the news outlets today. Non-farm, the headline number, 517,000 jobs compared to the 185,000 that we were expecting. Again, blowing it out of the water. Where is a slowdown in the jobs market? Not only is there no slowdown, it is 3 times expectations. It is amazing. Next number down is something that may be considered a good positive, which is participation rate. So this is something that is good for the economy, but at the same time, the Fed would like to see, which is the participation rate going higher. So from 62.3 going to 62.4%. And this is lower still than the pre-pandemic period, but ticking up, that's really good news because more people are coming into the workforce. So that's really, really good news, again, for the economy and for the Fed. These two are not as important. And next one down. So this is the biggest piece of that headline number. So this is the headline number, but what is contributing to that? It is private non-farm payrolls. 443,000 jobs. Again, compared to the 190,000 in the expectations. Just that's what, two something times more than expectations. It is unbelievable how the economy is growing and where these jobs are coming from. I checked the report, and the most jobs that are gained are in the leisure and hospitality. So this sector has been hurt the most by the pandemic, and throughout the past let's say 5, 6, 7 months, even more than that, this is the sector that has been adding the most amount of jobs. Okay, U6 unemployment rate, which is the higher unemployment rate, again, counting all the people that are seeking a job and all the people that are not seeking a job, this a little bit ticked up to 6.6% from the 6.5%. But the headline unemployment rate, again, something that you're going to be hearing about in all the news outlets and something that probably the president's going to brag about, going down to 3.4%. So half, we were expecting it to tick up to 3.6. Not only did that not happen, we're at 3.4%. That is super, super low. It is unbelievable. Keep in mind that before this period, like if you asked an economist in 2015, 16, 17, what is a neutral, meaning full employment rate for the United States, it's around 4.5%. Why? Because you are always going to have people that are looking for a job or going from a job to job or just wanting to have some time off. And that is why it is normal to have a certain percentage of unemployment in the economy. But these numbers of 3.5% and now 3.4% is just unbelievable. Keep in mind that the Fed is expecting, or in their forecast, they had unemployment by the end of 2023 at 4.5% to 5%. So that's their range, from 4.5% to 5%. And not only are we not going up there, we're going downwards. Again, totally the opposite of what the Fed has been projecting and what it is expecting. So the markets pretty much plummeted on the news. We're going to see how trading goes through the rest of the day. Again, this is one of those reports where good news is bad news. If we did not have inflation, this would be amazing and stocks would be jumping and everybody would be super happy. But because we're fighting inflation, this is everything that we do not want to see right now. So where the market's going to go, it will be very interesting, but this report's pretty much the exact opposite of what the Fed was expecting. Thank you so much for watching and see you in the next video.